This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
We've been talking about it throughout the program, throughout the day. U.S. retail sales, also producer prices, both rising last month by more than forecast, driven higher by fuel costs that risk tempering household spending and keeping inflation elevated. The reports, along with consumer inflation data on yesterday that showed an underlying price measure that rose more than forecast last month, they altogether indicate that U.S. households are feeling the impact from higher costs. That said, consumers have remained remarkably resilient when it comes to these headwinds. Angie Solanki is National Director of U.S. Retail at the global real estate services firm Colliers. She joins us on Zoom from San Francisco. Angie, we love it when you join us to give us an idea of what's going on in your world. How are you?
I'm great. Thanks for having me again.
Yeah, thanks for coming back. So what are you seeing across your portfolio, across the clients you're speaking to? What are you seeing when it comes to retail?
It's really interesting because we are seeing, the conservative numbers in terms of spend. Although, core retail for the month of August was up just by 0.1%, so not significant. So to your earlier comment that things are slowing down a little bit. If we look at where the increases are, they're still layered in with inflation. We're going to see a little bit of a, call it slowdown. Consumers are very cautious. They're being cautious because they're not buying impulse any longer. So we're seeing, consumers going into stores, they're browsing a bit more. They're not buying on the impulse or the discretionary items. So there's a bit of a slowdown. It's really buying for a purpose. Right?
How do you measure impulsiveness?
Yeah, I mean, it's a great comment, right? So I think that, if you look at what we've seen in, call it that revenge spend back in 2021 and 2022, I think people are starting to realize that we need to really take a pause, slow down, think about what our real necessities are and needs. Prices are increasing at the grocery store. Prices are increasing elsewhere in food spend. So I think people are saying, hey, we need to take a pause, not go in and start to, look at the shelves that hit us right when we walk in to the front door and say, hey, we may not need all these, call it accessories or items that are just not purposeful anymore.
What are you seeing on the food front? Because it looks like food inflation is slowing a little bit, but maybe not as much as, the consumer would certainly welcome. How are they going out and dining?
So it's interesting to see. I think we're seeing, the basket spend in groceries start to slow down. It's a smaller basket size. And what that really translates to is that we're starting to see an uptick in spend in F&B. So these are like eating out at, quick service restaurants. So your Chick-fil-A's, your Raising Cane's, your, F&B that's just easy to get to. It's convenient. It's somewhat affordable because you can still get a full meal for four or a family of four for less than what you may spend at the grocery store. So we are seeing a nice healthy uptick year over year in our, in the quick service side in F&B. It's almost by 14%. So it's a pretty healthy number.
Wow, that's more than I anticipated. And because it seemed like the likes of, when you looked at the earnings that we heard, maybe last month and in the month of July, that folks who could cater to a broader subset of the public, your McDonald's, for example, were doing better than the, I guess, higher end food plays. Does that jibe with what you're seeing now?
We are, because if you stop and think about the different type of, call it emerging fast casual restaurants that are coming out, they're opening quite a bit of locations throughout the U.S. And these are companies such as, Dave's Hot Chicken. As I mentioned, Chick-fil-A continues to look for locations in their opening. Raising Cane's is starting to open everywhere. They just opened one in New York and in downtown. So they are bullish. I think their price point is very approachable. And because of that, and it's good quality food as well. You're going to still see consumers go, okay, I have the ability to still spend outside of the grocery stores, and I have the opportunity visit all these different types of fast casual restaurants. So I don't see a slowdown there at all.
That's interesting. What about a slowdown when it comes to sort of competition here? You just mentioned so many different companies. A couple of those are relatively new upstarts like Dave's Hot Chicken. Is there a concern? And I know this isn't necessarily your coverage area, but you have such a good view at Colliers with what you're doing there and across the portfolio, across the real estate landscape. Is there a chance that consumers start to get bored of all the chicken?
I know. I personally, I was like, first I couldn't even realize that, is there enough chicken out there first and foremost? But
There have
I
been
think,
issues with supply chains in the past, but I think we're past those.
sure. 100%. So I think what we're seeing here is that people want variety. People want, even though your base is chicken, right? There's still a unique, I think, offering from all these different brands. And so with that, I think you're still going to see people go, well, let me try this new concept out and let them be the ones to say, hey, I may enjoy it, but maybe my kids may not, and they want Chick-fil-A. Well, what you've just done here is one person's going to possibly Dave's Hot Chicken. The other one's going to go to Raising Cane's. They're going to say, hey, Mom and Dad, take me to the other one. It's close by. So what you're starting to see is that people are saying, hey, I'm okay if it's not a far drive to go to one or two different, fast casual restaurants because my kids really want that specific brand. And I want a different brand for other reasons. People are still going to do it. I think they're close enough where it's convenient and they'll make it happen. So I just see that, these emerging brands, these newer brands are still going to continue to expand.
One of the things that some folks, especially I think of credit rating agency Moody's, has called out is that there could be a rise in retailer bankruptcies upcoming. And we've seen this sort of start to trickle in slowly with some smaller players. I imagine one of the first things they would do is get behind on the rent. Where are there any pockets in which you're seeing this actually come to fruition?
I think really when the pandemic occurred, it was kind of a correction, right, in the market in terms of landlords and retailers were really working in partnership to make sure that they could be healthy going forward. Now, as we saw this significant increase in sales in the past years, and we're now starting to see, call it more of, I would say, a stabilization, right? So year over year, past 10 years, retail has seen a pretty healthy growth. And that's around about, say, 4%, 4 to 5%. Now, you do layer in inflation, but the good news is inflation's coming down. So with that, what we're seeing going forward is we actually are forecasting more store openings than actual store closings. And with the store closings, it's, you can call it bankruptcy, you can call it right sizing of portfolios. It's really allowing the retailer to be much more, focused around optimizing their portfolio. So it's healthy to have store closures in certain markets. And that could be purely because of either, operational items, labor costs, maybe their location wasn't in a prominent part of that market or in the right area from a market share perspective. So I think we're beyond that. It's really more looking at, and of course, these are going to be retailers that are much more, focused around their store growth and new customer growth versus those that are just unable to kind of move forward. Those retailers that have that type of struggle, we'll definitely see them, cross over into a complete bankruptcy and or portfolio closure of all their stores. And that's purely because they just haven't reinvested in their brand.
Angie, are we at this point back to that 2019 conversation of quote unquote experiential brick and mortar retailers doing what they can do to get people into their stores, providing experiences that they can't provide online?
100%. I mean, what's really interesting is we're seeing a pattern now with online sales starting to stabilize, and we don't see this, kind of significant swing that all sales are, being channeled through online. I think it's healthy to have both online as well as brick and mortar for retailers because, people want that convenience to shop and how they want to shop. But going back to your question, what we're really looking at here is, there's the experiential that's occurring right now. We're seeing that in a whole host of different, venues, if you want to call it. So, for example, Panera has their, fully digital location. So there's no in-store or there's no seating
Yeah.
inside,
It's
which is
an
really cool. I mean, it's great to have that.
it's a really interesting concept seeing these smaller stores open up that are for like delivery or takeout only. Anji Solanki is National Director of U.S. Retail at the global real estate services firm Colliers, joining us this afternoon on Zoom from San Francisco. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Well, people familiar with, pop culture might know the reference in this song. The reason we're talking about this or hearing this is Walt Disney, according to Bloomberg News, has held exploratory talks about selling its ABC network and TV stations to local broadcaster Nexstar Media Group. That's according to people familiar with the discussions. We got with us right now Bloomberg News entertainment reporter Chris Palmieri in our LA bureau. Also with us, we have Bloomberg Wall Street Week host David Weston. He's in the Interactive Brokers studio with us right now. David was former president of ABC News from 1997 through 2010, and before that, he was president of the ABC Television Network and general counsel of the parent company, Capital Cities ABC. Good to have you both with us. Chris, I want to start with you. Just give us the news here and what we know so far.
Well, there's some interested parties now in buying ABC, the network, and its 8 local stations, which are big markets, Los Angeles, ABC, and in New York, for example. And so it's Nexstar, which is the largest owner of local stations, is one of the parties that's held preliminary talks. We also have heard that Byron Allen, who owns the Weather Channel and a bunch of other local stations, has expressed interest as well. So we're far from a deal, it seems. Disney seems to have trouble making up its mind whether it really wants to go forward with this, but there are people interested.
Chris, can you talk about how likely anything like this would be to go through as well? I mean, we've seen an FTC that's incredibly reactive, I suppose, proactive at the moment. I mean, is antitrust kind of a concern here, or is that something?
Big concern. I mean, they essentially didn't let the acquisition of a local station owner, Tegna, go through earlier this year. That was a sale to private equity. So really no traditional sort of overlap and antitrust issues. Whether that would be a cause. I mean, if you had an ABC would, in this scenario with Nexstar, for example, own CBS affiliates and NBC affiliates, Fox affiliates, whether all those local those networks would be happy about being owned by ABC remains to be seen. So, yeah, that's a big concern.
I want to bring in David Weston, host of Bloomberg Wall Street Week. As I mentioned, former president of ABC News from 1997 through 2010. Spent years also as president of the ABC Television Network. David, you've spent a lot of time at ABC, spent a lot of time at Disney. If this were to go through, would it be the end of an era?
Yeah, but that era may have ended anyway. I mean, streaming sort of has changed an awful lot of eras, and I think to some extent all the media companies are trying to figure out what the new era is, not whether we're going to continue the old one. I mean, look at the bundle that's gone away. I must say, I'm not shocked that they're thinking about it. To say they're thinking about it is not to say they're going to do it. When Bob gave that interview and said everything's on the table, and everybody was, oh my goodness, how could he say that? Well, he wouldn't be doing his job if he weren't willing to consider everything, because I think the really turmoil and upset in the media business is just that profound. And if you're a CEO, you should be looking at all the options. So it doesn't surprise me to look at it. It would be quite a big deal, and there'd be a lot of complexity to it. But if it makes business sense, you can get past a lot of complexity.
Yeah, David, you said you're not surprised that this is something Disney may be looking at. Are you surprised it's something that they may be looking at with Nexstar specifically?
Well, it depends on whether their check can clear and how big the check is, right? I mean, let's be frank. This is business. This is not personal, and you'd want that out of any CEO and any board of directors. They're taking a look at what makes sense from a business point of view, and they have to assess things like what are the growth potential for the assets they're thinking about getting rid of, whatever those assets are, and also are they likely to be of more value in somebody else's hands than in their hands, or is it at least likely that the other person will perceive that they're of more value than they would be in Disney's hands? So those are the things you have to go through.
Chris, in terms of the Disney's push to streaming, not just with Hulu, but of course Disney Plus, ESPN Plus, and the like, how important is this division to that, or is it, since it's live news and local stations, not that important?
Well, Iger has indicated it's not that important. You certainly could make an argument that it's to keep it. I mean, it is profitable at this point. You have so much synergies you can do. There's big sporting events that run on ABC and ESPN. Obviously, the shows that starred or run on ABC can also run on Hulu and other streaming services. So this has been the model that all of these big media companies have been doing, is sort of putting the same content on different platforms. But I think Bob has indicated that traditional media company model, which is shrinking so sharply, it might be just better to just part with it at this point.
Yeah, but at the same time, if the traditional media model is sort of ending, and David, I'd love to get your views on this. Nexstar has been going out and acquiring bunches, lots and lots of stations. Also launched News Nation, a cable news channel. I mean,
it's an enormous number of stations. I do think it's probably helpful. I'd be curious what Chris thinks about this. To go back, I was there when Disney, it was at that point, sold the ABC radio business, which was a big business in radio. And I was there and talking with Bob and talking with the people involved. By the way, it involved Tom Staggs and Kevin Mayer, the people who are there with him now. And they decided basically either they had to really double down and go bigger and invest, or they needed to get out because there was huge consolidation going on in radio. Television's not radio, but it sure is starting to rhyme with it. When you get an Nexstar that has that many television stations, I mean, I never would have dreamed of a world where anybody could own that many television stations. So the question is that the future of television? It doesn't go away. Radio didn't go away. It's just that they added a lot more stations. Well, exactly, but they added a lot more stations, and they consolidated. They stripped out a lot of costs, and they tried to make it up by selling in bulk the advertising. So you have a lot of advertising units across a lot of properties. And the question is that a model now for television stations?
Okay, let's talk numbers. Go ahead, Chris.
Point. Yeah, I was going to notice Capital Cities, which is how Disney acquired ABC, also owned a lot of newspapers, and they sold them off. And I don't think anybody would dispute that was a smart decision. So, those legacy media businesses can lose their value pretty quickly over time.
Yeah, as Chris says, they're still profitable, but the question is the margin. I remember, I don't think indiscreet at this point, 20 years ago when I first went to Cap Cities as the general counsel, seeing the presentation on the margins for the big owned stations in Los Angeles and in New York, and it was north of 50% margins.
Huge.
Oh, it was amazing. Now, I'm sure they're not getting that kind of margin now. They've still got a significant margin, but what's the margin going to be next year and 5 years from now and 10 years from now? I don't think it's going to be bigger.
I mean, there was no Facebook, there was no TikTok at that point. Google was just barely around at that point. Hey, Chris, what are the numbers we're talking about here? How much could the ABC stations, the network, be worth?
$4 billion is what our Bloomberg intelligence analysts came up with. That's based on about 7 times the EBITDA, which is around $570 million. That number was a big surprise to me. Disney doesn't break out the broadcast business anymore, but I can remember it being an $800 million to $1 billion business, not too many years ago. Pretty consistently as well, so it's almost halved.
Well, as my dad always says, something is only worth what someone else is going to pay for it.
Yeah, and you also have to ask after tax. Now, they can get around things, but one of the issues when you do a deal like this is the basis in these things is like nothing. And so that's a lot of taxes to pay. They got to be figuring out a way to get around it. And by the way, with the new money for the IRS, they're clamping down, right, on some of the spin-off situations.
Interesting.
So it might make it difficult. I'm not saying they can't get past it, but I'll guarantee you, if they're actually working on this, there are people working hard on that question.
So the lawyers are always the winners, David.
That's always true in life. Yeah, absolutely.
That is. Okay, so Chris, what else could be, David brought up Bob Iger's interview recently where he said everything is on the table here. We're just talking about the network and the ABC stations at this point. What else could Iger be shopping around?
Well, we know he's also looking for a minority partner in ESPN, and he's indicated that's probably going to be something along the lines of a technology provider. You can think in Apple or Google, somebody like that would have not just money, but sort of expertise at distributing this content in new platforms, because that's the direction they're going. There's going to be an online-only ESPN in the very near future. So that's happening. Right now, the whole TV business is just in a real state of flux, and so they've got to figure out a way to make the Disney Plus and streaming businesses profitable. They've got to get their deal done with Comcast to buy the 1/3 of Hulu they're required to buy. So just a whole lot going on at Disney.
Hey, David, could you, just because you spent so much time there, talk a little bit about how things used to work with synergies when Disney released a movie? GMA would be all over it. The parks would. What was the machine? My perception was when Disney bought Cap Cities ABC, Michael Eisner ran Disney, and Michael made a huge. He had committees for synergy, and he talked about synergy all the time, and he got resistance everywhere he looked. Bob, one of the things that's underestimated about Bob is he came in and with really a velvet glove got the synergies done. And behind the scenes, he's the one who actually got synergy done, and he was great at it because he didn't demand it the way Michael did. He didn't bully you. He just sort of cajoled and had some people look at it, and they did a terrific job. It was a terrific job. I mean, from the perspective of like a Star Wars movie or something comes out, there are Star Wars themed rides across parks now. You would see it promoted on Good Morning America. Yeah, absolutely. I mean, that would be gone. Some of that would be gone. Well, it depends on what the deal says. Yeah. When they sold the ABC radio networks, ABC News Radio continued with Disney, and they had a long-term deal with the buyer to make sure they took the programming. You can work around a lot of those issues with contractual provisions. But yeah, you'd lose some of the synergies, I'm sure.
That's so interesting. And I guess it's interesting as well as a lot of this stuff goes to these more consumer accessible plays, like what synergies have completely gone away as well, no longer exist in the business anymore too. Yeah, that's a good point. Hey, Chris, just before we let you go, just give us an update on the Bob Iger turnaround.
Oh, still a work in progress.
Still a work in progress.
Yeah, I think he's I don't know if he's necessarily having second thoughts of coming back, but he probably should be. It's been a rough year and a half now since he returned, so.
Well, he's got his work cut out for him. I'm rooting for him, but he's a friend, so I've got an interest in it. I want him to do well. Thank you for the disclosure, David Weston. Hey, a big thank you to both of you also for joining us. Chris, congratulations to you and Thomas Buckley on breaking this news. Shares of Disney higher by 1.4% right now. Also seeing shares of Nexstar higher. Chris Palmieri, entertainment reporter for Bloomberg News. David Weston, he is the host of Bloomberg Wall Street Week, also former president of ABC News, and he was president of the ABC Television Network and general counsel of the parent company, Capital Cities ABC.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, now that U.S. markets are closed, let's look east to perhaps one of the most consequential economic and geopolitical risks at the moment, which is China. We've seen the property market collapsing, dismal economic recovery post-COVID, any number of geopolitical squabbles with the United States. To discuss this, I'm pleased to bring in our next guest, Jim Chanos. He's the founder of Chanos & Company. Thanks so much for joining us. He's in studio, our Interactive Brokers studio. He says China's on a treadmill to hell. And shared those concerns with the House of Representatives Select Committee on the Chinese Communist Party this week. Talk to me about the hearing. Were you able to kind of get a sense of whether or not, and I know you weren't there physically in person, but you did offer your insight. Were you able to get a sense on what the committee's doing? Are they going to be successful? Are they going to do anything, in fact?
That's above my pay grade, and thanks for having me, as to the politics in Washington. And I do think that the committee is doing good work in calling attention to these issues. And we've been pretty negative on China now for a better part of 13 years, and I think that the risks that China poses have morphed from purely financial to now beyond that into the political realm and the national security realm, and I think that makes this a bigger story, and the economic model risks as to how China sort of deals with those may in fact affect the politics. And
does the contagion spread beyond what I think most people are expecting at this point?
The good news is that the risks to the real estate market and the economic model do not have a lot of direct contagion risk to Western banks, and particularly American banks. Where the risks are in our equity and debt investments that various funds hold, pension funds hold, retail investors hold, and I think that's the bigger issue as opposed to a 2008 type transmission from their real estate bubble bursting to everyone's real estate bubble bursting. They can keep that internal, but it's a big problem.
What are the threats beyond an economic collapse or a property collapse in China? I'm talking geopolitical threats, national security threats. Yeah. What's the stuff that keeps you up at night?
Well, the morphing from spending on the additional high-speed rail link that's unprofitable, or the next apartment building, and putting up and basically building another aircraft carrier. The classic 1930s scenario where a number of countries ramped up their defense spending as a way to stimulate, and we know how that ended. And so I think that we saw reports even today, I mentioned it earlier, that Chinese defense spending may be a lot greater than we think, as high as 4% of GDP. The U.S. is 3% of GDP. So they are spending more money. It used to be directed internally with internal security systems and that, but increasingly now it's hard to miss that it's also external with the Blue Water Navy and increased tensions around Taiwan.
Well, let's talk about that. I mean, how much of a concern do you think that is right now, an invasion of Taiwan?
Well, as I said earlier, I think the real risk is something happens, right? An incident that's unexpected, right? You have now ships transversing, crossing each other's bows. You have a lot of aircraft in the area, and all we need is someone, a pilot to make a mistake or get scared or a mishap of somewhat, and then you have an international incident, and that's, I think, as the temperature kind of rises in the South China Sea, I think that's the real risk, as opposed to a premeditated, attack on a Western country or Western ally.
So you want to short China potentially?
We've been short China for years. Paradoxically, we're less short China now than we were 10, 12 years ago, because China has gone nowhere. I mean, the stock market has basically been flat for 12 years, and as every other stock market has tripled or quadrupled. So it's been a very poor place for Western investors to park their money for years, not just for the last 12 years, but really for the last 20 years. And I think that's going to continue to be the case, broadly speaking. China does not treat Western capital very well.
How are you betting against China right now?
We have some direct shorts in the financial area. We have some indirect shorts that depend on China for a fair amount of their revenues. But as I said, our direct shorts are probably no more than 4 or 5, 6% of our portfolio. In 2010 and 11, it was above 20%.
We've spent a lot of time over the past few months talking about the struggles of the Chinese economy and the data that we get, or the lack thereof of data that we get, Jim. What evidence do you have that the Chinese economy is actually worse than what Beijing says or what markets already believe?
Yeah, the funny thing is that if you have an investment-driven economic model, which they do, the GDP is actually accurate. I noticed something over the weekend that Michael Pettis pointed out, that in an investment-driven model, GDP growth is actually an input. It's not the residual, which I think is a really interesting observation. That is, I've always joked that China's the only major developed economy that knows its annual GDP on January 1 of that year.
I saw that in your
tweet. And so whatever the numbers needs to be, they will put enough stimulus in terms of new investment to hit that number, give or take. So I don't quibble with the actual numbers they're putting out, but it's the quality of the numbers, if you will. That if you never write off bad investments, the actual costs to GDP are sitting in your banking system in terms of bad debts. And you have to either inflate that away or recapitalize your banking system. And so that's the nexus of this economic model with economic growth. And it's a banking issue, ultimately. And so I think that's where I worry, that as long as the banks never write off the bad debts, that's where the quality, if you will, of disclosure is poor.
Let's shift gears just slightly on our last minute here before the break. You're sticking with us. The ARM IPO was today. Shares rallied 24%. Stock closed $63.59. Your thoughts on the valuation?
It seems a bit high.
It's a bit high. Are you not convinced by the AI craze?
I think it's 120 times earnings, and I think revenues are $2.5 billion and went out at a $60 billion valuation.
And 25% of its revenues come from China.
Yeah, so almost 25 times revenue seems a little steep, but what do I know?
Are you going to short it?
Well, you can't yet, so it's a limited float, and but I'm sure at some point we'll crack open the prospectus.
Have you been thinking about shorting NVIDIA?
No.
Don't get in the way of the.
We have things that are perceived as AI plays that are trading much more expensive than NVIDIA does. So no need to go after the OG.
Well, we're back with legendary short seller Jim Chanos of Chanos and Company. We were talking before we went to break about the era of AI. What kind of opportunities has this opened up as someone who looks at the market with a very critical eye?
Well, I think anytime we see one of these tectonic shifts in new technology, like the internet in the 90s, people at first embrace everything. Everything is going to benefit. But what you find out, of course, is that when it's truly a major shift, is that those technologies end up harming as many businesses as they create. And so if you think about the companies that were in the business of distributing analog physical products that became digitized, they went away. Blockbuster Video, Eastman Kodak. I mean, companies like that, record stores. I mean, and I suspect that if AI is as big as most people think it will be, you will see lots of businesses that had moats find out that the moats have been breached. So your software as a service, what prevents a corporation from having AI design its own software for various different applications, right? And there's lots of things that suddenly you don't think about. I kind of joked a little bit a few months ago when IBM's CEO came out and said that AI may make some of the IBM workforce redundant. And I joked, well, what happens when the clients find that same thing out?
Yeah, that's a really good point. I want to shift gears a little bit and talk about your strategy around shorting and what you're seeing in the market today. I think a lot of people, of course, understand your history with being a fraud hunter and going after companies like Enron in the past. I'm wondering if over the last few decades, with regulatory changes, you've seen fraud reduced, or are there increased instances of potential fraud out there?
I've called this the golden age of fraud. I think there's more fraud in the financial markets now than there has ever been.
Why?
And I teach a course on the history of financial market fraud. So the cycles go back to the late 17th century. I think that it always changes, but what really has me bothered now is that a lot of it hides in plain sight in the way in which companies report their business and their metrics. So prior to say 10 years ago, you really had to sort of, if a company was making unusual changes to its earnings statements, they would have to explain it away. And nowadays, adjusted earnings are basically the norm. And companies add back all kinds of things that they don't really
it is a little wild.
Care expense. Oh, it's amazing. Coinbase in the fourth quarter of last year, I think share-based comp was almost 80% of revenues, and they just added it back.
I mean,
and so it's
we go back to the why WeWork didn't go public the first time.
Yeah.
Community adjusted EBITDA.
Yeah, that was
at this point it's a joke, but then it wasn't a joke.
I know, and investors lost a lot of money, and the SEC, promised kind of a crackdown on this a number of years ago. They admonished companies, as I recall, to not lead with these kinds of results. But I mean, for God's sakes, General Electric in the first quarter had 16 pages of adjustments on its earnings release. I mean, it's really, and companies that just take restructuring charges annually. Every year they take a restructuring charge. Well, if you take it every year, it's recurring. And I think that in Silicon Valley is in particular, pretty bad at this, where companies that lose hundreds of millions of dollars every quarter are reporting, break-even adjusted profits. And so you just wonder if they're really businesses or are they executive enrichment schemes?
Question mark for you. Although this is the golden age of fraud, activist activity has dropped by 85% since it hit a peak in 2015. These are numbers from Direct Market Intelligence. Yeah, it answered the question I posed just before the break. I mean, is the era of the short seller behind us?
I think everybody asks that during every bull market. 1999 and early 2000, it was the same sort of question. Will short selling ever work? And it's sort of the corollary: does value investing ever work again? When people pay higher and higher prices for questionable corporate assets. And the question is generally, it comes back, and businesses generally find their true value over time. I mean, just look at the meme stock, run up and now disaster from 2021 to today, and there was no price too high to pay for some of these stocks because they had a short position. And ultimately, most of them have come crashing down to earth.
We'll get back to that specific one in a second. But first, I want to ask about the, rising short seller in the market right now, Nate Anderson at Hindenburg. He's been big bets against Adani, or rather, he's said very public negative things about Adani, Icahn Enterprises. Do you see eye to eye with some of the calls that he's made?
Look, I think Nate and Hindenburg have done great work on a number of names, Nicola and others, and you'd be wise to at least hear what they have to say, even if you don't agree with it. If it's well researched and like anything, stock prices are opinions based on facts, and so at the end of the day, it's essential for a marketplace, whether they're positive facts or negative facts. And if you're a good investor, it behooves you to basically hear both sides of any story.
We'd be remiss if I didn't ask for an update from you on Tesla. Shares up 124% this year.
Yeah, we are short Tesla. We remain short. It's one of our 44 positions that we have. Look, Tesla is in many ways, I think, epitomizes this bull market. It's a hopes and dreams stock. It's trading at 75 times earnings, which aren't growing anymore. It looks like revenues are going to be challenged in terms of growth. So it's now, again, an AI story or a robotaxi story or a battery story or a robotics story. It's whatever you want it to be. And it reminds me a lot of Cisco back in 1999 and 2000, where Cisco was a networking company. Tesla's a car company, but Cisco was going to get into everything else that had anything to do with the internet, and people put a higher and higher multiple on it, and ultimately Cisco did okay, but the stock price dropped 90%.
I'm going to do a quick lightning round of some stuff that has been reported that you are or have been short recently. Just have me yes or no's if you're still short. Digital Realty Trust?
We are short the data centers.
SL Green Realty?
SL Green is, we are short commercial real estate.
Okay. Tesla, you said. Sunrun, you said.
The solar leasing companies, I've called them science projects. They're absolutely hysterical. They lose hundreds of millions of dollars, huge negative free cash flow. And getting back to our early conversation about metrics, they report rather than a regular P&L, which would be embarrassing, they report these net present value calculations based on the panels they put up on people's roofs, and it's absolutely hilarious the way they do it. And I think investors are going to find out the hard way about it.
All right, Jim, we're going to spend the last 40 seconds with you getting your thoughts on what you're watching, what you're streaming, what you're doing, and what you're seeing at the movie theater. New movie out, Dumb Money. It's got Pete Davidson in it. It's got Seth Rogen in it. Are you going to see it? Have you seen it? It's all about meme stocks.
I told one of your colleagues earlier, I don't see the need since I live Dumb Money 5 days a week in the marketplace. So at some point, I'm sure I'll see it. I think it celebrates the meme stock investors winning over Wall Street and the evil hedge funds. The sad thing is that most of those meme stock investors have lost large amounts of money, chasing these ideas, because, as we pointed out, a lot of these companies came crashing down to earth, and in some cases have already gone bankrupt.
Hey, Jim, really appreciate you taking the time and joining us, especially
thank
for such
you.
a long period of time. Jim Chanos, the founder of Chanos and Company, legendary short seller here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Well, it's the third largest pizza chain in the world. It's got stores in every state in the U.S. and 27 countries and territories. And for the second year, it's the official pizza sponsor of the NFL. We're talking about Little Caesars, the Detroit-based pizza chain known for, well, its pizza, and of course, the guy who says pizza, pizza in the ads.
Pizza.
It really is true. We're very pleased to have with us Paula Vissing, president of global retail at Little Caesars. She joins us from Las Vegas today. Paula, how are you?
I'm very good. Thank you. And thanks so much for having me today.
You're welcome. Be honest with us about the pizza thing. That thing is something you hear all the time, right?
You would be surprised at the numbers of times I'll be on a plane and, you sort of chit chat with the people sitting next to you. And I'll tell people that I work for Little Caesars, and immediately they will say pizza, pizza. So yes, we hear it all the time.
There's a real marketing
That's
question
great,
that,
though, yeah.
well, there's a real
Yeah,
marketing
go ahead,
question
sir.
that I have for you about this. I mean, that's something that I remember from my childhood when I was literally, under 10 years old. Talk to us about the marketing and, and the how the staying power of that phrase and how it hasn't changed over time when so many other companies have significantly changed the way that they get their message across.
Right. You're exactly right. I mean, we're really so fortunate to have something that is so iconic, be affiliated with Little Caesars, be something that people understand and recognize. It's not just in the United States. As we open restaurants around the world in some of our biggest markets, we hear the same thing repeated to us. So we're very, very fortunate to be able to have something that is so recognizable to people that we can continue to utilize to communicate the benefit and power of Little Caesars.
I'm going to ask something more deep here because we got CPI data, or inflation data out earlier this week. And one of the trends that we've seen recently has been that food away from home still increasing at a much faster pace and a price perspective than, just eating food at home. I know it's always cheaper to eat at home. How are you seeing this, I guess, in your own company, in your own stores?
Mm-hmm. Certainly over the last 2 years, the same inflationary pressures that everyone in the industry is seeing, we've experienced. We've been able to manage our business very well. We've taken some pricing where that was necessary. But, I think if you look at our business right now, we continue to offer a great value that's very important to us. And I've seen the same data that you've seen. And so, if that's what folks are experiencing, that heading to the supermarket's a little bit more expensive, hopefully that'll give them more incentive to head to a Little Caesars.
Hey, Paula, sort of in the same vein as Simone is asking about, it's always a challenge to cover private companies because we don't get the quarterly reports from you. And you've been family owned for years and are still held by the founding family.
Exactly.
Give us some numbers, though. Give us some numbers that we can work with.
Yeah, if you'd like to talk with me again, I'm gonna take a pass on that. But want to be respectful to the ethos of our company, which is to stay, to keep that stuff confidential. That's something that was very important to our founders, and we all continue to believe in that. I will tell you, our business is performing very well this year. We're very excited about it. Our franchisees are excited about it, and we look forward to that continuing.
Where do the franchisees see the costs increasing? What do you hear from them?
Mm-hmm. As I said, the same things that we just talked about. Certainly that period last year and going into or coming out of 2021, where you had so much extraordinary commodity inflation. We all experienced that. But again, I think the strategies that we've had in place, we've taken pricing as many people in the industry have. We've just been able to kind of settle into the right place for us, where we still got the right price value equation that allows us to meet the needs of our guests and continue to offer a really affordable, great tasting product for them.
Are you guys preparing for the prospect of a true recession here, or have you done enough preparation that you feel like, well, we don't have to really do much more in case of a downturn?
I think it's a great question. I think that, we're always try to make sure we're always mindful of what the economic situations around us could be. If that's something that happens, and I'm confident you've got other guests that are better positioned to offer a point of view about whether that's likely to happen, we'll be prepared to continue to provide our guests with a great tasting product, a great tasting, affordable product.
Hey, Paula, when I was doing research ahead of this interview, I was really surprised to find that for so many years, you didn't do home deliveries at Little Caesars and started again back in 2020, which ahead of the pandemic, I should note. So it was kind of like perfect timing there. Give us an update on deliveries. Why did you take a multi-decade break from delivering pizza, and how's it going now?
Yeah, fabulous question, and thank you for that. And you're exactly right. For so many years, we built our business off, our hot and ready model, the most convenient way to grab a pizza, come in and grab it, and be in and out of the restaurant in 30 seconds. But as you said, in 2020, we made the decision to launch delivery. Just happened to be right before the pandemic, which was certainly helpful to our business there. But the reason is simple. We consider one of our core values to be making sure that we are convenient to our customers. And the fact is that there are guests who want their product brought to them. And so that was really the guiding principle for that. It's been really great for us. We continue to move forward with that.
Sure, yeah.
We hear great feedback from our guests. They really like it.
We've only got about a minute left, but I just want to ask, are you finding it very challenging or not as challenging to hire workers in this scenario? And are you doing anything different to retain them?
Yeah. Again, just like everybody in the industry, I would say certainly through last year, we experienced the same thing that many folks in the industry did. For us personally, we have about 600 company restaurants, and our franchise partners, we're finding things a little bit better. There are pockets where there are still struggles. And so we continue to move forward. We believe, and this is something we work on with the company restaurants as well as with the franchise partners. We think it starts with making sure the right culture is in place in the stores, and really working hard to make sure that Little Caesars is a place that you want to work.
Hey, Paula, come on back, and especially when you're in New York, come join us here in the studio. We'd love to have you. That's Paula Vissing, president of Global Retail at Little Caesars, joining us this afternoon from Las Vegas. This is Bloomberg Businessweek.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, it's hard to believe we are almost there. In fact, we are less than 12 minutes to the close of U.S. equity trading here on this Wow, Thursday afternoon. Excuse me. Time flies when you're having fun. We just heard the numbers from Charlie. Worth repeating, though. The Dow up 1% right now, 348 points to the upside. The S&P 500 up a little more than 0.8%, over 4,500. The Nasdaq higher right now by just about 0.8%, 115 points to the upside. Let's get with our next guest, George Schulze, founder and chief executive officer at Schulze Asset Management. George, this afternoon joining us on Zoom from Rye Brook, New York. George, good to have you with us this afternoon. How are you?
Thanks, doing well. Good to be back. How are you?
We're doing pretty well. Looks like traders are having a pretty good day as well. We just heard a lot of the headlines from Charlie. We got the ARM news. We got hotter than expected PPI and retail sales a little earlier today. Where do you fall on things right now?
Yeah, it certainly seems like we're back in a risk-on move right now, and I think there's still a lot of cash sort of sloshing around the system, so people are getting excited, and the inflation figures earlier this week are probably giving people optimism that maybe we're close to the end of the rate hiking cycle, and possibly it's time to really put on risk again. So we'll see how it all goes.
That's a pretty optimistic take from someone who is writing about the alarming rise in bankruptcies and defaults worldwide that might signal imminent changes ahead. Those are some notes you sent across to us. Does the momentum shift dramatically then from the kind of optimism that we're seeing in certainly the equity markets today?
Yeah, well, listen, we've certainly seen a big spike in interest rates from absolute record lows of just a couple quarters ago. And there are a lot of companies that borrowed a lot of money prior to that move up. And it's just, it's concerning for those companies. It's also concerning for the banks and other lenders that lends money at a fixed rate of interest, really at the record lows for the interest rate cycle. So even though the economy seems to be recovering and doing quite well now, and people seem to be more optimistic in the markets, that doesn't mean that we can't go through what would really be a kind of normal default cycle with a certain percentage of companies, call it 3 to 4%, restructuring and having to go bankrupt and ultimately deal with sort of a changing environment with much higher costs, not just with interest expense, by the way, but also just inflation going through most corporate income statements and balance sheets. So I think that's sort of a challenge, but it's not a systemic problem that will cause everybody else to fail.
Where are you seeing opportunities right now?
Good question. One thing that we think is very interesting right now is this Grayscale Bitcoin trust.
Oh, talk about that a little bit.
Yeah, it's kind of an interesting one-off situation where you have a publicly traded trust that's currently trading at a large discount to the value of its underlying Bitcoin that it owns. Now, this trust has been trying for years to convert into a regular retail ETF, and the SEC has really clamped down and shut them down and not allowed them to do that. But Grayscale recently won at the district court level a ruling just a few days ago, and we think that helps unlock that value going forward. Of course, the situation has not been resolved yet, and the SEC, of course, could appeal the ruling. Perhaps this case goes all the way up to the Supreme Court, but we think here at Schulze Asset Management that eventually the SEC will either just give up or will lose, maybe even up at the Supreme Court level, and that Grayscale at that point will be able to convert its publicly traded trust into an ETF, which should help eliminate that trading discount, which earlier this year was as much as 50% of the value below its trading price.
Oh, that's pretty interesting. So interesting, Grayscale. Well, where else are you seeing some opportunities right now?
I think there's lots of opportunities for short selling companies that are over levered and that are facing that risk of, problems with their lenders. So, we think the best opportunity there is to short sell the equities of those companies, because when and if there is a restructuring, and in many cases it will be inevitable, the shareholders typically get wiped out. So that's one opportunity. On the other hand, some companies have taken the opportunity and gone through a restructuring and cleaned up their balance sheet, and some of those present excellent value-oriented investment opportunities with lots of upside, given where their current stock prices are trading.
Do you think the opportunities for distressed are going to increase in the near future as a result of higher rates?
Absolutely is a good question, and if if you think about that, looking backwards, there really weren't that many opportunities in distressed land over the last few years. When we had the COVID crisis, for instance, there should have been a big restructuring cycle, but then we got so much financial liquidity from the government and so many bailouts that you really didn't have a default crisis. And so looking back over time, interest rates were just so artificially low that we haven't lived through a normal default cycle for a long time. And so if you go to sort of a normal average rate on defaults, again, maybe 3.5% or 3.75% of the total of debt outstanding getting restructured, that would create a lot of opportunities. And so, yeah, we do expect that. There's also a lot more debt outstanding these days than there has been in prior cycles. And so I think it's inevitable that you'll have a restructuring cycle with more opportunities in distressed land.
George, I'm looking at WTI over $90 a barrel for the first time since November 2022. How does that play into the opportunities that you see in distressed space?
Interesting question. Yeah, I think it does in a lot of different ways. And I think the price of oil is just sort of emblematic of where commodities all trade. And it's a sign of inflation, really. But that can impact certain companies in certain ways. I mean, certainly, looking back a few years, in fact, at the beginning of the COVID crisis, the price of oil dropped to below zero. And there were lots of companies in the space that produce oil and other commodities that restructured back then. Well, now those companies look great because they're generating lots of cash flow. And some of them, took the opportunity when prices were so low to restructure their balance sheets. Now, of course, they're generating so much cash flow, and it's likely to increase with these higher prices recently, that they can be aggressive with returning capital to their owners. And so that's an exciting opportunity in the oil patch space.
Do you see the price of oil going down in the long run?
That's really hard to predict. But I do think that there's a lot of structural things going on behind the scenes in the oil market that make it unlikely. I mean, you have the cutbacks from Saudi, you have the ongoing conflict in the Ukraine, and just generally, a global economy that seems to be doing pretty well, that's supporting demand. So with increased demand and relatively limited supply, in my view, there's a good likelihood that oil prices should stay here or maybe even appreciate from here.
I believe we have a Disney red headline here coming across the terminal. We've been talking all afternoon about some of these potential talks with Nexstar, but Disney now said to cut target for Disney Plus streaming subscribers. So that kind of adding to this question marks about where it gets its future content.
Yeah, that's a good point, Simone. I mean, when it comes to Disney, certainly the company is going all in on streaming right now. This was started under Iger. It was expanded under Chapek, and now it's continued to be invested in under Iger. But the big question is, what happens as the decline of linear, and can you make up for it with direct-to-consumer streaming? That's Hulu, that's Disney Plus, that's ESPN Plus, and more.
Yeah, George, just quickly here, we only have about a minute left. Disney has a decent-sized debt pile, I believe something like $11 billion, but Bloomberg Intelligence saying they may have to go back to the market. Do you have any views on that?
I do. I don't think Disney is a candidate for bankruptcy, but clearly there's massive secular change happening in its industry. And, we've seen it with Sinclair and with Diamond Sports, a subsidiary that's currently operating in bankruptcy. And Disney's back and forth with the cable companies is certainly emblematic of that. So whenever you have an industry like this with massive secular change, if you have operators in it that have too much leverage, it's a recipe for potential bankruptcy. And that's where Diamond Sports is right now. So we'll see how this all plays out with Disney, but it's certainly something worth paying close attention to because so much is changing in that space.
Hey, George Schulte, love it when you join us here on the program. He's the founder and CEO at Schulte Asset Management. He joins us on Zoom this afternoon from Rye Brook, New York.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.